Hello friends, welcome back to the US Stock GPS channel. It's Friday, October 10th, and we're looking at the US market after the close. Today, all major indexes fell sharply. The Dow dropped about 1.9%, the Nasdaq plunged 3.6%, the S&P 500 lost 2.7%, and the Russell 2000 sank 2.99%, marking the biggest single-day decline since April. Let's talk about what kind of sell-off this is, what may come next, and how we can respond. What triggered today's sell-off? The main trigger was President Trump's threat to impose massive tariff increases on Chinese imports. That instantly sparked fears of a new round of Trade War II, raising concerns about global trade and corporate profits. This move came in response to China's announcement just a day earlier, expand export restrictions on rare earth elements and related technologies, citing national security reasons. Rare earths are essential materials for U.S. industries, like electronics, semiconductors, jet engines, and defense technology. In retaliation, Trump threatened to impose 100% tariffs on Chinese imports starting November 1st and to add new controls on key U.S. software exports. The news immediately triggered a broad sell-off. The Nasdaq Composite tumbled more than 3.6%, led by technology stocks, many of which rely heavily on global supply chains in Chinese markets. As investors rushed to safety, Treasury yields fell, and gold once again closed above $4,000 per ounce. Market sentiment shift. The VIX Volatility Index surged more than 30% in a single day, reaching the 2830 range, its biggest daily jump since April. This spike shows a clear shift. From complacency to risk aversion, investors are now actively hedging their portfolios against further downside. How should we manage risk? If you're not yet highly experienced in using options to hedge risk, partial position trimming is the most reasonable step right now. Today's decline is not a panic crash, but a structural correction driven by policy uncertainty and valuation pressure, the kind of pullback that usually lasts for several trading days. You don't need to exit the market entirely, but you should lighten up in high volatility or overvalued sectors and wait for stabilization. Trim exposure in stocks or ETFs that have broken below key moving averages, MA10, MA20, MA50, especially in semiconductors, AI hardware, and small caps. Keep or slightly add to defensive areas. Utilities, healthcare, and gold miners remain supported by risk-averse capital. Avoid emotional selling. Hold some cash and wait for better re-entry points once markets calm down. Specific position guidance. SPY, no trimming needed, risk remains low. QQQ, hold for now. If it breaks below MA50 but not MA100, trim 10% to 30%. MAGs, trim 20%. SOX, trim 50%. NVDA, PLTR, ORCL, no trimming needed. AMD, trim 20%. SLA, trim 60%. AVGO, trim 40%. Meta, trim 70%. Goog, trim 10%. Mu, trim 10%. AMAT, no trimming. OMSN, trim 40%. AAPL, MSFT, no trimming. Market outlook. Scenario A, stabilization and rebound. If trade rhetoric cools and policy risks ease, the market may stabilize near short-term support and stage an oversold rebound. Deeply hit sectors like semiconductors and tech could bounce back toward mean levels. If Treasury yields hold steady and the Fed maintains a dovish tone, defensive sectors, utilities, healthcare, and gold will likely stay strong, while AI and cloud stocks could gradually regain momentum. Scenario B, prolonged selling pressure. If trade tensions continue to escalate or China retaliates, risk aversion could rise further and trigger a second wave of selling. Combined with missing economic data from the government shutdown and possible downward earnings revisions, market sentiment could deteriorate further. In that case, high volatility and high valuation names may face a second round correction. Key things to watch. Trade and tariff developments. Any new policy comments or official responses could instantly swing sentiment. Treasury yields and liquidity. Rising real yields would keep stocks under pressure. Critical support levels. S&P 500 near to 6600 SPY is approximately equal to $665. Nasdaq around its key moving averages, sector rotation. Watch whether defensive groups continue to lead and whether tech can stabilize. Earnings guidance, especially from semiconductor and cloud computing companies, to assess margin and profit risks. Final take. Today's decline looks more like a post-rally structural correction than the start of a crash. If no new geopolitical shocks occur, markets could stabilize within a few days, though volatility will likely stay elevated in the short term. Thanks for watching, everyone. If you found this video helpful, please subscribe and give a thumbs up. See you next time on US Stock GPS.